Hello, my name is John Wherton and I lead the liquidity management team here at Legal & General Investment Management. Thank you very much for taking the time to listen to this presentation on making ESG meaningful within cash management. ESG has been a key topic within the investment industry for some time, but it is something that our liquidity clients are always interested in. In particular, what does ESG really mean for a money market fund? So today I would like to cover some of the challenges and pitfalls when thinking about ESG and money market funds. Why I think ESG is going to be more important to us as cash investors in the future, and how drawing on a long-term investment perspective has helped me to think about ESG risk. First, some background to provide the context. Many of you will be familiar with Legal & General, one of the largest insurance and asset management groups in Europe, and Legal & General Investment Management, which manages almost 1.3 trillion in assets across a range of strategies to support clients' long-term investment objectives. Inclusive capitalism is a key principle that drives the Legal & General corporate strategy as an investor, house builder, and long-term steward of client assets. This in itself creates a diverse array of cash management requirements, but around 20% of our liquidity funds AUM is cash managed on behalf of corporate treasury clients. The LGIM liquidity funds support the operational cash needs of daily liquidity and capital stability, while the Liquidity Plus fund is available for more strategic cash allocations. To deliver this, we draw very deliberately on LGIM's broader investment capability, which we break down into the macro, credit, and risk management components. Within that credit piece, there is, of course, a consideration of environmental, social, and governance risks. But I've always felt slightly uncomfortable with some of the ESG or socially responsible marketing around money market funds, as exclusions of weapons manufacturers, fossil fuel extractors, or tobacco producers doesn't mean very much if these companies hardly or never issue into the money markets. Money market funds hold short-term government and agency issuance, but primarily bank paper. However, in recent years, money market fund providers have more explicitly described how they incorporate ESG risk into their credit quality assessments. And at LGIM, we utilize an active ESG tool, which draws on external data as well as LGIM's internally generated analysis. The top-level ESG score for an issuer within the money market fund universe, however, won't in itself tell you very much. The high credit quality global banks that money market funds invest in will be exposed to a lot of the same ESG risks. And historically, ESG concerns for banks have related primarily to governance risk, AML, payments, or risk management controls, where a data point or indicator is often backward-looking. So the really useful part of this process for our credit research team is capturing the underlying data, which they can use to stress test an ESG concern against adverse scenarios, capturing its materiality within a forward-looking credit opinion. This has led to between 3 and 5 exclusions at any one time based purely on ESG grounds, which is relatively meaningful if you consider that the average money market fund will be exposed to around 30 or 40 issuers. This doesn't mean that there are no ESG risks within the remaining issuer universe, just that the material ESG risk has been mitigated. So from a broader ESG investment perspective, a handful of exclusions alone has a limited impact without the final step, which is engagement. Engagement or stewardship has always been important to Legal & General. From the 1970s thalidomide campaign to secure compensation to the affected children and their families, all the way through to today's extensive corporate engagement. These issues have material financial implications over the longer term. So it's through active stewardship that we seek to secure better outcomes for our clients. And here, the money market fund investment universe is actually becoming increasingly important within the context of ESG and beyond governance risk. Within the policy and economic challenges of transitioning to a low carbon economy, financing is crucial, with associated implications for bank loan book quality. And the social responsibility of banks was highlighted last year as they were looked to in order to mitigate some of the economic consequences of the pandemic for their clients and customers. Client data and cybersecurity are also important risk factors as banking becomes more digital. It's possible to see LGIM's engagement activity on climate change in particular, where third parties capture this information across the industry. But the overall story here is that there's more to be done, and investment managers have a responsibility to continue to step up their efforts. As I mentioned, how issuers within the money market universe are positioned for the policy and transition risk associated with climate change is going to be an increasing area of focus. And the LGIM Climate Impact Pledge reflects this importance of financial institutions and banks. There is no conflict between considering ESG risk and the investment objective of our liquidity funds. These forward-looking risk assessments are made within the context of the broader investment process that I mentioned. And setting expectations, monitoring and engaging with institutions supports our ability to assess the credit implications of ESG risks alongside the macro and risk management components, enabling our liquidity funds to operate at all times through 2020, for example, within conservative internal as well as all external mark-to-market and liquidity requirements. As a corporate treasurer, you may be thinking about ESG from a debt issuance perspective as well. So I would recommend the LGIM Active Ownership Report, now in its 10th year, as well as the LGIM blogs and podcasts for insight from our ESG and corporate governance experts. For the cash investor, the incorporation of ESG risk is an important component of the credit quality assessment. And the data and disclosure for banks is improving all the time and providing early warning signals. But we don't need to stop there. Through engagement and stewardship, we can also accelerate a change towards a more resilient investment universe and one that supports sustainable economic growth. I've really enjoyed the conversations that I've had with clients around ESG, so please feel free to get in touch if you'd like to discuss this or any other topics in more detail. And please make sure that you visit the LGIM virtual stand. Thank you for listening, and I hope you enjoy the rest of the conference.